Okay, hello everyone here. So thanks for coming. Sorry I missed the class this last Monday. I was stuck traveling a little bit later than I was supposed to be traveling. We had a little rainstorm in Argentina that really slowed us down. The funny thing is when I went into the airport, the weather was perfect, and when then I was there waiting for the flight and everything like that, the craziest storm I'd seen in a long time, the sky turned black. It was nasty. And so our plane was delayed taking off, and we were sitting on the plane, and I couldn't get access. There was no internet access on the plane, so I couldn't get into FX Street to let them know that my plane's delayed and I may miss class. So I ended up missing this week's class on Tuesday. I apologize, but this is the makeup class for it now. So thank you all for being patient on that. I appreciate it. Broadcasting live from Greece, so I'm in Athens right now, and got some business things I'm doing, very exciting stuff, but we'll have to save all that for later. So today's class is, of course, the topic of today's webinar is price action. And when I talk about price action, I'm really talking about three components. Most of the people, in fact, if you look at all the other price action traders out there, they're all talking about the structure of the price action. You know, what is the structure of the price action? Price action in its most simplest definition is prices movements over time. If you look at every single price action trader out there, everyone you'll find out there that's out in the internet that is known for price action, they're only talking about structure, which is how the candles form. Is it a wedge pattern? Is it this pattern? You know, they're only talking about structure. And when I'm talking about price action, I'm talking about structure, but I'm talking about two other things as well. I'm talking about time, prices movements over time, because the structure may not be any sort of structure that is quote unquote seem tradable. You trade a certain amount of patterns, you know, you're trading systems. Hopefully if you're trading systems in the sense of not necessarily automated systems, but rule-based systems. And hopefully you are trading rule-based systems where the rules are predefined so that you know if I have A, B, C in place and they're all active, then I make a trade. If A, B, and C are not active, I don't make a trade. So hopefully all of you are at that stage where you have clearly defined rules and variables to execute your trades. But sometimes A, B, and C might not be in place for a particular pattern. You know, maybe you trade wedges and flags and pennants or something like that. Those are basic patterns. And so if you don't have those in place, then you're not trading. But the thing is again, those are based just upon structure. They're not based upon time, because the bottom line is the time that the market has been doing something, whether it's buying up or selling off, is a component of price action that communicates to you what the institutional market is doing. It's, you know, the only way that people seem to think that the only way you can determine what the institutional market is doing is just by looking at patterns, and it's just not true. You can look at the time that something has been selling off or the time that something has been buying up and know what the institutional markets are doing and what it's most likely to do. And that is something else that I'm talking about when I talk about price action. The third thing I'm talking about is understanding price action so that we can understand order flow. Because if you can understand order flow, since we don't have access to it, if you can look at price action and understand the order flow behind it, that it created such a move, then you can have more information to make a trade based on where the market is most likely to go next. And so anytime you're looking at price action, you really want to be looking at it and using whatever tools you have so that when you understand the price action, you're really getting a glimpse and you're understanding the order flow behind it. Once you can start to understand the order flow behind it and think about environments of order flow that would have created that price action and what they're most likely to produce as a result of that environment, then you can really start to trade the market. Then you're really starting to do price action trading. The first price action traders were the ones who actually had no charts to look at. They only had numbers. They had the numbers of the prices. And they also had the numbers of the volumes of how much was being bought at these particular levels. They had no charts whatsoever. They had to do it all in their mind. But what it is that they were able to really discern via the prices and the order flow what environments were being created and what was the market most likely to do. Then charts came along, and we being more visually oriented as humans than any other senses, out of all the senses you have there, 70% of the data your central nervous system takes in is visual. And so, since we're more visually oriented beings, we became more obsessed with the way things look on the chart, the structure. And now, then indicators came along, and then people said, okay, well, if this indicator looks like this, then I'll trade it. And we started to discard other methods of trading. We started to get away from understanding the order flow behind something, and we became involved with only how things looked on appearance. But unless you really understood the order flow that had created such appearances, aka price action on the chart, you were really more reacting and trading automatically than you were really understanding the contents of the soil that had produced such plants. Does that all make sense to everybody? Yes, no? Who understands what I'm talking about there? Or who feels like they understand? Fernanda says yes. Robin Manoj and Yaki says yes. Okay. Ken says gotcha. Fantastic. This is part of the problem that with the field of technical analysis or chart reading today is that everybody is so obsessed with the way structure look. But they are, how could I say, people have become so obsessed at the way they look, they have gotten away from looking into what is behind the charts. So we have a couple questions here, and I guess I know you guys are going. So Fernanda says, but Chris, time is really crucial, but that is what is so great about charts. One axis is time. Yeah, that's true. One axis is completely time. The funny thing is that's what people spend the least amount of effort trying to glean information from. And so that's what's interesting. Next question from Rob is, what about price as a leading indicator? Now, Rob, just so I understand your question correctly, are you asking question A, is price a leading indicator? Or are you asking question B, what components of price action is a leading indicator? I want to make sure I understand your question correctly before I answer it there. So is it A, is price a leading indicator, or is it B, what components of price is a leading indicator? Both. Okay. Did you intend that from the beginning when you asked your question? Oh, that's funny. Okay, so let's get into each one here. You did not. Okay, that's cool. All right. First of all, which did you intend? Did you intend your question to be A, is price a leading indicator, or B, what components of price are a leading indicator? What was your intention when you asked that question? A. Okay, great. So let's get into A first. But it's good, though. We've been able to discern what the actual question is. Now we can determine how to answer that. Question A is, or component A is price a leading indicator? The answer is yes if you know how to use it. The answer is no if you don't know how to use it. How is price a leading indicator? The answer to that is really the only way that would be an answer, or that it is yes a leading indicator, is if you understand what kind of order flow had created that particular environment. Because only once you understand what kind of order flow had created that particular environment will you know the greatest probabilities of where price is going to go, where it's not going to go, whether this is a tradable environment or whether it's not a tradable environment. Structure alone won't tell you that. Structure cannot tell you that is a tradable environment. It can give you clues that it is, but the bottom line is, why do the structure of price action give you some sort of clues? Because it's pointing to a particular price action environment. It's pointing to a particular order flow environment that had created that. And once you understand that order flow environment, then you can. If you're just trading structure, you won't understand the order flow, then you won't really understand it's a leading component. And so, yes, price can be a leading indicator if you understand what kind of order flow is behind it. And structure and time are two methods of breaking down or giving us information of understanding what order flow had created that environment. The answer to the second question, B, what components about that are leading indicators, I've answered that. So I've kind of answered it in one real gestalt there. Does that make sense to you, Rob? And does that make sense to everybody else? You also have to understand that there may be environments where price is not a leading indicator. And that will be where there really is no cohesion in the price action. Now, Yaki has a quick question. How about volume not relevant to spot effects? If it's not relevant to spot effects, why are you asking? Because you want to know about other markets? Sure. Volume really is a product of order flow. And because it's a product of order flow, then it is absolutely useful. Price action is a product of order flow. Price action is the result of order flow. Price action doesn't cause order flow. Well, it can in the sense of the traders' minds, and then they place the trades. But the bottom line is the order flow determines price action. It's a one-directional relationship. So hopefully we can get in that question there, or hopefully we've answered that question there. Okay, Rob now, and there was one question in here right before this, which is, hello, sir, what price action targets do you see for your US dollar and pound US dollar? I'm not going to get into that right now, Jack, because first of all, the question is too ambiguous. And I'll tell you why it's ambiguous. What price action targets do you see for the US dollar and pound US dollar? Well, that would depend upon what time frame we're looking at, doesn't it? Because the time compression that we're concerned with would determine what are more probable targets. But B, my job here is not to, my job as an educator is not to fish for you. My job is to teach you how to fish. If I fish for you, I'm not teaching you how to fish. Which means you'll always be dependent upon me, which means that when I'm not here, or the next educator's not here, you will be screwed. And guess what? We are not going to be here all the time. We are not going to be at your computer when you're making trading decisions. And here's the other problem with it. If you don't know how to fish, what happens if I tell you the price action targets, and I say, here's a good place to get in, here's a good place to get out, and then we're done talking, and you're in the middle of a trade, and I'm not there. Well, here's the problem with that. Because I'm not with you at your computer all the time, the market's a live market. What happens if I say, here, your first target is 100 pips, and your stop is 50 pips? What happens if something unique comes out in between the time you enter the trade and the time that it hits your price target? What if something unique comes in that can severely affect the outcome of that trade, either to the downside or to the upside? If something significant comes in and I'm not here to help you out and the next person's not here to help you out, you will have no idea what to do. You'll have no idea what to do and you're screwed. because you don't know how to fish. So my goal as an educator is not to teach you how to fish, or is not to fish for you. It's to teach you how to fish, because you are not going to always be with us. And so me as an educator telling you price action targets, regardless of whether you specified the time or not, isn't going to help you grow. It will help you make money in the short term, but guess what? You're going to lose money overall because you have no idea how to fish. And so it's the antithesis of what I am doing here. Hopefully that makes sense, Jack. And if you understand that, then you understand why I'm not going to answer that question directly. That doesn't mean I'm not going to give some trade suggestions. I'm going to give some trade suggestions. Absolutely. We'll get into it at the very end of the class. But the bottom line is I'm not going to spend my time doing that. I'm going to spend most of my time teaching you how to fish, how to hold the rod, how to reel people in, where you want to find fish. That's what I'm going to be spending most of my time here doing. So hopefully that makes sense, Jack. And if you understand that, then you will spend and direct most of your efforts towards asking me questions as to how to fish and not fishing for you. My job is to enable you, not to disable you. Okay, Rob has a question here, so let's get into this question here. Rob has a question, how do we determine order flow? This is an excellent question. There are a couple ways that we can do this. How do we determine order flow? Determining order flow is easily done if we have specific rules or patterns that we're looking for. It's easiest to do us through this method because if we have those patterns, we can kind of already glean what kind of order flow environments have produced this kind of price action. That's the easiest for us to work on. Excuse me, I'm adjusting my headset here. Those are the easiest for us to do because they kind of do all the homework for us. But the bottom line is this, is that those patterns aren't going to always be around. And you're going to have to be in environments, where when those patterns aren't around, you're still going to need to be able to determine order flow by looking at the price action. And if you can only do it when the pattern's around, you're really kind of limited. You really only are walking around on crutches. And so let's talk about some of the methods and techniques you can do to determine order flow without the patterns. So let's get into that, and then we'll start to get into some of these things here. Okay, and then I'll get into, there's a couple comments later from Fernando and Joker. We'll get into them in a little bit. Okay, and Joker said it'd be better if you explain your basic concept for your PA. Joker, I agree with you. It would be better to explain my concepts regarding PA, time, and order flow instead of answering specific questions. Absolutely. But at the same time, and I agree with you, I'm completely agree with you. It would be better if I did that instead of answering specific questions about euro, dollar, pound, dollar, and these things like that. However, there are specific questions which can be very useful for us to get into, because that will allow us to teach people how to fish. So, okay, so let's get in that. One of the things that I'm really concerned with when I'm looking at price action, and let me zoom into this chart here. In terms of structure, we're just going to talk about structure, then we'll go into time, and then we'll go into that. One of the things I'm often looking at in terms of structure is, and this is critical, impulsive versus corrective moves. This is one of the most important things that you will be doing when you are trying to look at price action, determine what the market is doing, is finding impulsive versus corrective moves. Why is that? And what is an impulsive and what a corrective move? An impulsive move is a move that moves kind of powerfully, forcefully, energetically in one particular direction, either to the downside or the upside. Why is this an important thing for us to know? It's important for us to know because for something to move powerfully, forcefully, energetically in one particular direction, it has to have strong order flow behind it. The market can't move powerfully, forcefully, energetically in one particular direction without strong order flow, either to the buy side or the sell side. It just can't do that. It's not able to do that. If there is no overwhelming imbalance of buyers or sellers, aka if there's no situation, if you're in an environment where it's 50% of people are buyers and 50% of people are sellers, and it's the same not just on number of trades but also on volume, it is impossible to have an impulsive price action environment. The market just won't move that. The market moves impulsively when the market is skewed more towards the one side of, let's say, 60, 70, 80% of the buyers, or 60, 70, 80% of people are sellers. That creates an impulsive environment. I usually, and not just but that usually is the case once the market starts to get about 60% on one side and 40% on the other side. And when I'm talking about 60%, I'm not just talking about the numbers of buyers or sellers. I'm talking about not just the numbers, but I'm also talking about the volume as well. So if there is currently $20 billion involved in Eurodollar at this point in time right now, 60% of that would be 12 billion of the market is, long or short, and then the other 8 billion is on the other side. Usually once the scales get tipped to about 60%, this allows the market to take shape, directional shape. It now has the capacity to really take on a direction. And so that is usually around the line in the sand where the market takes direction. Okay, so the further you go along that spectrum, 60% and above, the more forcefully the market will push in that direction. We want to look for environments that are in that 60% or above. Because if we do that, then that means that more of the institutional market is on our side if we're in that direction, and we increase the probability that we are going to make money. Does that make sense to everybody? Because the bottom line is you and I will probably in our lifetime never move the market. I may have a chance to move the market, but it's unlikely any of you in here will. Or if you could do it, if you work your asses off and you really develop good in trading, and maybe 1 year, 3 years, 5 years, 10 years, you're trading a big load of cash. I am much more closer to that than you guys are. But the bottom line is, let's just say we are unlikely to move the market. If we are not moving traffic, then you're going to have to learn the rules of the road and learn how to obey that traffic. That's what we're doing. So, for us, the highest probability to make money as a trader is to be on the side where the greatest amount of order flow, orders, and volume is. Those are impulsive moves. Okay. Corrective moves. We are unworthy. You're not unworthy. You're totally worthy. Just because we don't move the market doesn't mean we're unworthy. We're totally worthy people. So, corrective moves are the opposite of that. They are environments where the needle is more in the middle of that spectrum, in between 60% long and 40% short, or 60% short and 40% long. That is the environment where you have the least amount of probability of making money, because the order flow is unlikely to choose a direction. And when you take a position, long or short, you're taking a direction. And you want the market to move in that direction to make money. The more the needle is in the center, the harder it is for you to make money. Impulsive move and corrective moves have physical characteristics, and they have time characteristics as well. What are the physical characteristics of an impulsive move? Physical characteristics of an impulsive move are the candles tend to be larger than usual, or in the sense of if you were to take an entire set of candles let's say a month, 6 months, a year, whatever, those candles are going to be larger than usual. Why are they larger? Because the needle is more on one side of the spectrum, long or short side, and because it's longer, there's an imbalance in the market. That means there's more force being applied in one direction of the market. And so one of the defining characteristics, and this is very important to recognize, and this is something that I'm always watching and concerned with, is the size of the candle. The size of the candles tells me when the institutional market is involved heavily and when they're not involved. So, for example, we're looking at this chart right here. Let's delete this line here. I'm not sure why it's here. Some of the larger candles are here, 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 here. Good sized ones here. And on this most recent up move, we have a couple of decent sized candles here, here and here. That alone is cueing me into the fact that the market is heavily involved. And in this case, right now, the institutional market is more involved in the long side than the short side. A couple other characteristics from a structural standpoint of an impulsive move is the closes. The open is not necessarily as important in the structure in terms of close and determining impulsive move, because here's why. The closer the market is to the top or the bottom when it closes, indicates to you the strength of the buying or selling pressure for that particular time frame. Here we're looking at a daily chart. So all these candles are daily candles. If the market closes towards the high or the low, then that tells you to some degree the strength of the buying and selling. Because why? If the market closes very close to the high or the low, that tells you the institutional market wasn't really taking profit going into the close of the candle now, were they? Because if they were, let's say the market was pushing up all day, well then the institutional market's heavily involved on the long side. If 10 minutes, an hour, 2 hours before the daily close candle of that candle comes, they start taking profit, you're going to see a wick. The other thing is that maybe there is still, let's say there's 20 billion involved on the euro dollar for that day, and 12 billion or 14 billion, whatever, is involved on the long side and 6 billion is on the short. If the shorts come in and try and match that volume and pressure, then they will also push back on the market and create a wick. That wick will reduce the strength of the buying or selling. So the close communicates an immense amount of strength or weakness in terms of the buying or selling. Closes closer towards the highs and the lows increase that strength or weakness. Does that make sense there? So we're just talking about structure here. We're not even talking about time yet. We're referencing time, but we're really talking about the physical structure of the candle. Does that make sense to everyone there? Now we'll get to Launcer's question in just a second. Yes, no? People feel like they understand? Yes, of course. Okay, fantastic. So those are two things that I'm often looking at in terms of structure. As a general thing, I'm looking at impulsive versus corrective moves, and I'm looking at impulsive moves. I'm looking at, from the structural standpoint, closes, and I'm also looking at size of the candles. Because you could have something that closes towards the highs and the lows, but it may not be that big a candle. Rob says, repeat the part about the closes. What part? I said a whole lot there. Hope you're not saying all of it. Okay, I'll let you go with that. No. What part about the close do you want me to repeat? Because I said a whole lot. Well, I'll come back to that. I'll let you type that in. In terms of a time spec, closes near the, not closes near the, I never said anything about closes near the open. I said talking about closes near the highs or the lows. So a close near the high or the low represents a greater amount of strength than a close near the open. The market profile. Okay, so is that answer? And I'll get to your question. First, I need to get to Lancer's question, then I need to get into your question, Alex. Okay, before I answer both your questions, I want to get into one more thing about impulsive moves. Another way to characterize impulsive moves is not just in terms of the structure, but is also in terms of the time. Time as in, let's say we're looking at this move here. Okay? This move right here. From here to here. And I'll put the top and the bottom. There are two ways that the time involved in this move can be useful to us. Obviously, the faster the market gets there, the stronger that needle is on the spectrum of impulsive, 60%, 70%, 80% on the long or short side. The faster it gets there, the stronger it is on one side. There are two ways that time can be useful to us. The speed at which the market gets from point A to point B, and also how long it's taken to get from point A to point B. When I talk about speed, we're talking about how quickly did it get there. Just because something gets there quickly, 2 candles, 3 candles, 5 candles, instead of 20, let's say it normally takes, let's say the ATR is 100 pips a day, and the euro dollar has moved 1,000 pips, it should have taken about 10 days on average. But if it gets there in 3, that tells us that the market is getting there forcefully, very forcefully. Now, that's a useful environment to us. Just because it maybe takes 10 candles to us doesn't mean it's not a useful environment. It doesn't mean that it's not something we can trade. No, we can trade it. But what's more important is that how many of the candles were directional. This is called frequency of time. Frequency of time is relating to, hey, this thing moved from here, 3670 to 2431. Let's just say it's roughly 1200 pips. How many candles did it do it? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 10, 13, 14, 15, 16, 17, 19, 20, 22, 24 candles. How many of them were in the opposite direction? 1, 2, 3, 4. So 4 out of 24 candles were in the opposite direction. That means that 20 out of 24 candles were selling. Or in other words, 5-6. AKA about 75, 5-6, that would be about 85% of the time the market was selling. Okay? So 85% of the time. That refers to the frequency of time involved in that particular move. Now, if something is moving 85% of the time in one particular direction, then that communicates information to us as well, doesn't it? That means that if there was 100 candles, if this move was 100 candles long, 85 times out of 100 it was selling off. Why is that useful information to us? It's telling us that on a day-by-day basis, the overall participation in the market was dominantly short, which means that tells us the order flow involved in that was dominantly short. That's very useful information to us. It's useful information to us because it tells us the long side of the market was so absent from the market or so weak involved in the market that they couldn't even muster more than 4 out of 24 candles to the long side. They could not even push back on the short side other than 4 out of 24 times. That communicates to us a degree of weakness, an immense amount of degree of weakness. Does that make sense? So can we see how the time, in this case, communicates information about the market, not just structure? Yes, no? Okay, fantastic. Before I get into these 2 questions here, maybe there's a few questions here, about 3 questions. So, Before I get into these questions here. Okay, great. Fantastic. I want to briefly describe the structure of... Where's that darn question? Oh, I'm missing it. Lancer had a question. I want to find Lancer's question. Okay. So let's define corrective moves from a structural and time standpoint. And then now that we have those two, now we can really start to unwrap them and use them. We can start to use the hammer and the nail. From a structural standpoint, corrective moves are the complete opposite. The candles are not huge. They're small. The closes are generally not towards the highs and lows of the day. They're generally towards the middle. And from a time standpoint, they are a lot more mixed between blue and red candles, not just predominantly one color. So it's easy to describe corrective moves because they're just the opposite of impulsive moves, structurally and time-wise. Now, getting to Lancer's question here, he said, I thought corrective moves were profit-taking. Not necessarily. Corrective moves can be a product of profit-taking, but they can also be the product of... I can give you an environment where they wouldn't be profit-taking. Market, let's say there's 20 billion involved on that particular day, euro-dollar. That's the net volume. It's a lot more, but let's say there is. 13 billion long, 7 billion short. The market is pushing up for most of the day. The short side then all of a sudden increases their positions in volume to where they are about 9.5 billion. Or maybe even 8.5 billion. Well, what will happen is that those candles will start to go from big to small because there's almost equal forces on both sides of the market pushing against each other. So it will make the small candles small. Closes likely won't be towards the highs or lows. And you will start to see some red and some blue candles in that case. In that case, the market is most likely structurally to keep drifting up. Drifting at almost a flat angle. But it will be drifting up. That would create a corrective move. Corrective moves don't have to be against the current trend. Corrective moves can either be, if the trend is up, corrective moves can be down. They can be sideways, or they can be still going up, but at such a flat angle, almost flat angle, that it's not impulsive. So that would be an example of how a corrective move is not profit-taking. Profit-taking itself is most likely going to look like, if the market's moving up, profit-taking is either going to look like A, price hits a resistance and they start taking profit and then it moves sideways, or B, it starts to pull back and that pullback angle of the price action will be flatter or a more base angle than the impulsive move itself. So if the impulsive move itself, the price action was moving at, say, a 45-degree angle, and then they start to do some profit-taking, that profit-taking will almost never be the same angle as the impulsive move. The only time the profit-taking will be at the same move angle as the impulsive move is that the people that were long on the market are exiting positions to such a heavy degree that it's causing the market to reverse very sharply. So if there was, say, out of 20 billion involved in that particular day on the euro-dollar, if the market was 14 billion long, and the order flow then all of a sudden shifts to, let's say in this case it would be, if 8 billion takes out of the market, profit taking, they just say, we're out. Well then guess what happens now? Now the market is 14 billion short. So you'd have the opportunity there to create a sharp angle on that. If you see that sharp angle, that tells you a pretty fair amount of profit taking is in place. But if the angle is much flatter, say at 30 degrees or 20 degrees or 10 degrees, then that tells you that just a very small amount of profit taking is taking place. Does that make sense? So these are some of the ways that we can determine order flow based on the price action. Impulsive or corrective. Angle of the impulsive or corrective moves. These are just some of the techniques. Does that make sense there? Yes? No? And did I answer Lancer's question about how profit taking is not always, or corrective move is not always profit taking? Hopefully I did. Okay. Now let's get into Alex and then Dry Desert's comments. Alex says, I think all of this is taking us to understand the market profile. Am I right? No, it's not. Market profile is a particular set theory that is, market profile is taking a particular set theory about trying to understand a unique way of a price action environment. It's hard for me to answer that question without explaining market profile, because market profile is a big word. Market profile entails a lot of things. Market profile charts are completely different than these charts right here. Market profile is very concerned with tick volume, the amount of times that that price has received a particular tick in time. It's really concerned with how the market has, it is concerned with price and time, but we are trying to understand order flow for order flow's sake. Price action in relationship to order flow. Market profile is trying to do that, is trying to understand order flow in terms of price action, but it's doing it through a particular lens. And those are the predefined rules of market profile. I am not using all the same rules as market profile is. We share some of the same rules and some rules are different. So, does that answer your question there, Alex? Because market profile doesn't go into frequency. Market profile doesn't go into impulsive versus corrective. It doesn't go into how close is the close in relationship to the open. It doesn't go into all these things. It does cover some of them, but it's not basing everything off of them. So does that answer your question there, Alex? It's an important question. It's a good question. Yes, you see. Okay, fantastic. And there's two more excellent questions here. Dry Desert and Gonzalo's question. And good to see you again, Gonzalo. If this is Gonzalo from FX Street, good to see you. Excellent question. So let's get into Alex or Dry Desert's question, then let's get into Gonzalo's, and then we'll go from there. Dry Desert says, you're trying to find out if institutional traders are involved in the current move. If the market is near a daily close, but doesn't move past it. If the market is near a daily close, but doesn't move past it, I'm not sure if I totally understand that question, but okay, we'll get into that. Then institutionals are not involved because they would take profit there and would create a wig. If they're creating a wig, that would be interesting. Okay, Dry Desert, I'm not sure if I totally understand, but I want to make sure I understand your question before I really answer it. If the market is near a daily close, do you mean from a time perspective or some other candle's daily close? If you're talking about, hey, we're almost at the end of the day, I need to understand the nature of that question before I can answer it. I was trying to explain maybe what you said, or maybe I got it wrong. Okay. It wasn't a question I was trying to explain, Rob. Okay. Okay, gotcha. Okay, well then we'll come back to that, Alex. So, right down there. Oh, no, that was somebody else who asked the question here. So that wasn't a question. Okay, well let's get into, there's two questions here that I'd like to get into. And Alex will get into this one later. Arvin says, do you think trend reversals are an opportunity for great trade entry? That would depend on the type of trend reversal. there are some trend reversals which can be great opportunities, and there are some trend reversals that are not great opportunities. Dry Desert, I'm moving on because I didn't fully understand the nature of your question there, and you didn't offer me a follow-up explanation. So until I understand the nature of your question, then I can answer it. So if you can rewrite it in a very compact, succinct way, then I can answer it. But all those comments there, I don't totally understand them. So until I can understand it, I won't be able to answer it. So let's get into Arvin's question real quick. Do you think trend reversal is a great opportunity? Yes, the type of reversals, there are certain type of reversals that can be awesome trade opportunities. There are some that are less. V-bottoms are harder to trade as a whole than rounded shape bottoms or double tops and bottoms or P-bars, or these are all much more V-bottoms and tops are much harder to trade because they're much more fast and rapid, and they usually come as more of a surprise to some degree. So it's much harder to trade because the market has moved very quickly, very rapidly, far away from the point that it's reversed. Contrast this to, say, a rounded bottom, like on Eurodollar, over here, market's pulling back, but then all of a sudden the angle starts to round itself off and then work its way back up. This is a little bit easier for most traders to trade because it gives us a little more time and cues into the structure. It's like it starts to round out, starts to flat, and then starts to build up. This gives us a lot more time, gives us a lot more confidence to some degree. So rounded bottoms are easier to trade, and those are, I find them to be great opportunities. Rounded bottoms, yes. Bar Ps are good opportunities. Double tops and bottoms, sure, absolutely, depending upon the nature of the double top and bottom. So yes, we can get into more specifics of that at a later class. Maybe we can have a class where we just focus on reversals. That would be a fun class. Or, maybe we can have a class where we just focus on trending environments. That would be a fun class. So maybe the next 2 price action classes I'll focus on. I'll have to think about that. But hopefully I've given you a good idea of how to answer your question. Here's the thing. There's one thing I'd like to note. I'd like to put a disclaimer in that. This, I think, is critical. Trading being a counter trend, if you're trading a reversal, in some essence, you are a counter trend trader because the established trend is already in one direction. As a whole, counter trend trading is harder to do than with trend trading. Why? Because with trend trading, the trend is already established. So you no longer have to choose the direction. You just need to choose the where and the when to get in. That's all you have to choose. The direction is already established. The order flow has already been pushing in that environment. Because the money's already moving that way, there's already a higher probability that your directional entry is going to be right. So there's less work to do when trading with trend because there's already so much order flow in your favor. It automatically increases the probabilities of that. When you're counter trend trading, you are fighting that particular body of order flow that's been moving in one direction. And that's hard to do because your order is not going to move the market. And the thing is that when you're a counter trend trader, you are more likely to have less accuracy as a trader. If you were to take all the counter trend traders on the planet, and then you were to take all the with trend traders on the planet, I guarantee you that the with trend traders are going to have far higher accuracy ratios than the counter trend traders. Counter trend traders as a whole are a lot less accurate. So you have to be more accurate, which means you have to be better at what you're doing. The other thing is that you have to be more precise. Why? Because, let's zoom in a little bit here. Let's say this trend is going up and you're trying to find a reversal point. You find a reversal point here, you get stopped out, you lose money. You find a reversal point here, you get stopped out and lose money. You find a reversal point here, maybe you make some money, but maybe your target was a much deeper reversal. So you make a little bit, not much. And then you finally get one here. Well, you were kind of like 1 out of 4, maybe 2 out of 4 at best. So you have a relatively low accuracy ratio. If you're 50% accurate, I consider that to be low accuracy. That's what the market is automatically offering. It's going up or it's going down. You're either right or you're wrong. So there's nothing special there. There's no particular edge there. If you are a counter-trend trader, you have to be much more precise in terms of your entry, because if the market does keep moving against you, you're probably going to get stopped out. If you really want to be a good counter-trend trader, you want to be able to get in at a very specific point in time with a very tight stop. Because if you're wrong and the market's trending, the chances are it has a good probability to keep going against you. So the best counter-trend traders are the ones that are able to get in really good entries with very tight stops. That is very, very difficult to do in calling tops and bottoms and prevailing trends. That's why most traders will tell you, don't try and call tops and bottoms, because they already know it is difficult to do. So the natural prevailing wisdom out there already supports trend trading and already communicates to you counter-trend trading is hard to do. You have to be much more precise, you have to have much better timing, and you have to be much more accurate. And that is a harder thing to do as a trader. That's why I always tell people, look, unless you have very, 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 very specific and precise, well-tested systems for counter-trend trading, don't do it as much. Spend more of your time catching with trends and not going against them. As a whole, I think counter-trend trading is the hardest thing to do, and I don't recommend people starting off with that. Okay, that doesn't mean we can't do it. That doesn't mean it can't be profitable. It can be. It can absolutely be profitable. It's just harder to do. So that's my thoughts on that one there. Okay, I got to get going because Phil Newton, another price action trader, he's also an excellent trader. Him and I have never communicated, but being a price action trader, I've seen his stuff. He's excellent. Maybe he'll agree with some of what I said. Maybe he'll disagree. That's the beauty of this. Hopefully he agrees. So please stay tuned for his class. I've liked his work. He has great work. I hope you stay with it. And that's pretty much it. So until then, I will be back on schedule next week. I will be at that class. I'll still be here in Greece. And so hopefully I'll be seeing you guys here next week. Until then, I want to wish you all good luck trading. If you have any questions about our services, check us out at sexguysforex.com. And if you want to know anything about our courses, particularly our price action course, how these can help accelerate your learning curve, check it out. Email me info@secondsguys.com. Until then, stay here for Phil. Stay here for some more price action. I wish you all good luck trading. Have a great weekend, and I'll see you next time. Take care, everyone.